Hey, welcome back. I am Allison Dunn, your host here at Deliberate Directions and the Deliberate Leaders Podcast. Today, our guest is what I consider to be one of our expert interviews, where we can answer questions that you have regarding how to grow your business and help you on your leadership journey. Today's guest is David Riffe. He is a certified financial planner as well as an accredited investment advisor with the wealth management advisory firm of Gem State Financial Group. David and I are fellow Rotarians, which I think is one of the ways that we've connected. And today, the topic that we're talking about is buy-sell agreements. I personally, so David, thank you so much for joining me here today.
My pleasure.
I'm super excited about this topic, and I know it's probably a pretty dry topic for a lot of people, but it is, it's one of those things that when people start a business and when people exit their business, I think it's the most important piece of paper that anyone who is thinking about having a business needs to sign during that time. And so I just want to educate a little bit and then demystify maybe the complexity of it and simplify it in some way. So
you bet.
Start with the basics. Can you just give us a general idea of what is a buy-sell agreement?
So a buy-sell agreement is essentially a contract between business owners to buy themselves out or buy each other out in the unfortunate event if somebody passes away prematurely before the business is ready to be sold. So oftentimes, and I'm probably going to go a little further than what you're expecting on this, but oftentimes these contracts are set up with a price point, and I oftentimes work with those clients to help them determine what those price points are, along with a certified evaluation specialist. So I hope that answers your question.
It absolutely does. So does everyone need a buy-sell agreement?
Everyone needs a contingency plan. Whether or not they need a buy-sell agreement, that's up for debate. And what I mean by that is, if you don't have any partners and your business is solely based on you, you probably should find a secondary purchaser of that, somebody in your own business, for example. So like you, Allison, find another business coach that would be able to take on your clients for you would be a great transition strategy. And then that is, in essence, a buy and sell agreement because you put a price tag on that based on your prior earnings. So that protects your family. Anybody that's in a partnership, an LLC, S Corp, a small corporation, absolutely needs a buy-sell agreement.
Okay, thank you. That's pretty clear. I'd say one of the travesties that are certainly happening as our demographic, our boomers, are getting to retirement age is that they don't necessarily have a succession plan. And one of those things where, as a coach, I help people coach people with end in mind. And this is often a really difficult conversation. It's like deciding who will get your children, right?
Right. It's even worse than that because this is something that you've built from scratch most often. And your children, they go off and do their own thing over the years, but you're still hands-on this baby.
That is very true. So we raise them longer in some cases.
Correct.
So why use a buy-sell agreement?
Great question. Well, so think about this. If you have an entity and you have partnership agreements in place, and a buy-sell agreement actually solidifies the valuation of that partnership based on an interim markup, meaning if someone passes away prematurely and you don't actually get to see it through the sale process, you're protecting your family and you're also protecting the other party. Sometimes there's contractual things that happen. For example, if you're an attorney, I can't own a law firm because I'm not an attorney. So I have to set it up with somebody who's in that business and licensed to do the work. Same thing for like CPAs and architects. So it's important that you find the right partners, and it's really important that they put these things together.
So David, I want to just make sure that, so we're talking about buy-sell agreement you have in place in the event of an unexpected passing of an owner or one of the owners.
Correct.
What do you have in place when you set up a partnership, and how is that different? Like, let's say no one passes. Like, let's say it's just, I want to get out.
Well, that's a negotiation at that point. So that wouldn't really entail because the triggering event is death. So that would be like, hey, I'm knocking on my partner's door and I say, hey, Bob or Jim or Susie, I'm thinking about selling to you or selling to somebody else. And they say, well, let me have first grabs. But that's not, the triggering event would be the death.
Okay.
You
So
could also,
always triggered.
yeah.
It's always the trigger.
Well, not necessarily. You could have it set up so that if you become disabled and unable to do the work, then that's also a triggering event in certain contracts. So, but those are questions and thoughts that you should go through with your mergers and acquisition or business attorney that you're working with.
Okay. Fantastic. So let's talk about the structure of a buy-sell agreement. Can you kind of outline that for us?
Yeah, basically it's a contract between you and the other individuals. And sometimes if it's a corporation, you're buying out shares, that gets really complicated. And we're not going to go into all of the nuances here because it'd be really getting in the weeds. People fall asleep. So basically it is a contract between you and the other individuals to buy out their share of the business. Very simply.
Okay. All right. Fantastic. In current business day, is this something that all businesses do have, or is it common that they don't?
You know, it's amazing how many don't. So in my world, first thing I ask people when I'm working with an individual, for example, is, do you have home and auto insurance? And everybody says, sure. And then I say, do you have an umbrella policy? And half the people have a glaze in their eye. The other half of people say, I got that. And the other half that don't have it, the first thing they do is go out and get it because it's really inexpensive. This is a really great way to protect the asset that you've built. And everyone needs one, but very few have them. They don't think about the demise. Nobody wants to think about the demise of themselves.
So true. So what happens when we don't have one?
Well, it's a legal battle. And you could end up with here's the crazy one, or the crazy thing that can happen. So you and Jim are partners. Jim passes away. Now your partner is Jim's estate, which in essence is Jim's wife or new girlfriend or whatever it looks like, or his children. And that wasn't what you were designed to do to begin with. And those people may not have the talents necessary to carry the business forward. And so it's really important that you are able to actually keep and maintain your business, I would hope, and actually pay out your partner effectively. That's why one of these buy-sell agreements is really important.
So I know that there's a number of ways to be able to fund a buy-sell agreement, and
Yeah.
A wealth advisor. I'm hoping that you can kind of share some of those strategies.
Yeah, there's 4 common ways people will do it. And unfortunately, most of them are not really great. So what I mean by that is, so that you can go to the bank account and pay out the family. Okay, that sounds great, doesn't it? So you write a check for $500,000 or 200,000 or whatever. That depletes a lot of your bank account, or it puts you in the negative. You can borrow, and you can go to a bank and say, hey, I need $500,000. And the only problem with that is, oftentimes when you get in a situation like that, the bank is going to say, well, hold on, you guys just went through a situation and no longer are you the same firm, and we're not sure we're going to lend to somebody like this because of these question marks that we have. There's a risk there. So they become difficult to find loans. The other alternative to that loan note to a bank would be a loan note to the estate or the living spouse and pay them off over time. And that doesn't usually work because they usually want or need their money now, and or don't trust you to be able to maintain the business at a level that's going to be able to pay them out. And then finally, and this is the one that is probably the best option and works the best for most situations, is life insurance. So you buy a life insurance policy on the partner, and when the partner passes, or hopefully they don't, but if they do, then you're prepared with the cash to buy out the partner's family.
Okay, which I think is the most common way that I often hear. So
Yes.
last solution, but possibly the best solution.
Yep.
How about in a buy-sell agreement, you said that often the price is determined at the time that the contract is executed. So the price or the valuation mode?
Yeah, the valuation.
Okay.
I don't necessarily agree with that strategy, but people like to keep it simple. And the other way that they can do it and make it lock it in kind of front is to look at past revenues and just pay a percentage of that as well. But I like to have a real valuation kind of at the date of death, not really the date of death, but at the time of death, and get a real update, because then it protects the family that's in place. But what happens if your business has declined a little bit? You would maybe paying a premium to that family based on the price point that you set back 10 years ago. So let's say, for example, you're in the printing business and your business has declined 50% because everybody's now using digital brochures, or everybody's using Facebook or whatever. So your business may be worth 35% of what it was before, and you have a locked in price at this point, and that's not a good idea.
What would you say is the necessary team to have around you when you're considering creating a buy-sell agreement?
Yeah, so there's the first thing you want to do is enlist your attorney, and it should be someone who's got expertise in business transactions. I think is really important. Someone who understands the ins and outs of buying or selling a business. The struggle is a lot of business attorneys are not specialized in that area of the law. They're really good at doing collections, or they're really good at setting up contracts and that sort of thing, but they don't necessarily have all the nuances to it. So if they're not familiar with that, I think it's important that they find the right person to do that. And someone like you, Allison, as a business coach, can help coach them through the process of finding the right person to work with.
Awesome. Do you have any like specific guidance or words of wisdom, maybe even a story of things that, if you can recognize this in your life, this might be when you should take action?
Yeah. I have a story. I've got a client who, back about 10 years ago, unfortunately, one of their main competitors decided to pass away prematurely. And I don't think he decided to, but he had two partners, and they had a buy-sell agreement in place. And one of the things that I advocate heavily, and I work with my attorneys and CPAs on heavily when we're putting one of these together, is make sure the funding is in place. So in this situation, the buyout was about $3 million to the partners the partner that passed. And the unfortunate part is that they didn't have that much money in the bank, which is not uncommon. They knew that they wanted to maintain the business, but they didn't really want to go out and get all over leveraged from the bank, which the bank would have probably come through with it. And the family was not interested in taking a note. And unfortunately, they didn't go and buy the life insurance when they actually set this up. So my partner was the one that acquired their company. For $3 million, they acquired a company that was doing $6 million in billable accounting work. So for one half of 1 year's revenue, they got the whole company and all of their clients. So that was a huge win for them, my client. But the result at the end, initially, was the existing two partners, their efforts were diluted. They made about as much cash income as they did before, but they didn't have any ownership at that point. So they had to sell out for $3 million, and they didn't get to keep a penny of it.
That's a very sad story.
It is.
There's a win in there for the purchaser, but that is sad because we.
Now let me follow up with that. In the end, those partners actually benefited tremendously because they ended up with a really nice retirement package out of the deal. But at the onset, had they decided to leave, they would have lost. They wouldn't have had any equity, nothing to sell. So.
I think one of the questions that I get a lot, and I'm hoping that I never answer a question that I don't think I'm qualified to answer. So let me ask you, and then I'll affirm like that. That's what I tell people. Who pays for the insurance in the buy-sell agreement, and how does does that get taken care of over the lifetime of?
Yeah. So there's two ways. The business can buy it on each partner, and that's very common. And then there's a cross-purchase agreement where if I'm a partner, I buy it on my partner, and if I have three partners, I buy three policies on each of them. Okay, and then they buy three policies on each of us. So you can end up like with a ton of insurance policies. For simplicity's sake, most often companies will say, we don't want to deal with that. That's just too much work. Let's just go with one policy per partner, and we'll pay for it out of the pot from the middle. And that seems to be the fairest way to do it, because if, like, for example, if I'm the healthiest partner and I've got three partners that are morbidly obese and they smoke and they just have bad lifestyles, their insurance is going to be significantly more expensive than mine. So I'm going to be overpaying for that. So oftentimes the organization will pay for it.
Okay. So when the policy trigger happens, the event, the funds are then given to the business, and the business distributes it to the appropriate parties.
Correct. Yes.
And that's obviously a tax event as well.
Yeah. In the event of you owning the policy, you actually take the cash and you write the check to the family. Or you can do it through the business, but it comes to you because you personally own it. But you might actually own an LLC. There's so many ways to structure it, but you own it personally.
Are these types of policies term or whole life?
Great question. It depends. It might be a universal life policy, which is like a annual renewable term that starts off a little less expensive, which is a permanent policy. It all depends on really how old the person is that you're buying out. So for example, if I'm buying out an 80-year-old, a term policy probably is not going to be an option.
Yeah. Okay.
I'm going to have to go with permanent policy. So the permanents are the UL policies, universal life, or a whole life policy, which are more expensive to begin with, but over time they can accumulate cash as well.
Okay. And maybe this is way too complicated of a question, but my understanding regarding whole life or universal is that it actually is tax-free at the end. So when it does get paid out, there aren't tax consequences associated with it. Is that correct?
Yeah, well, actually, that's good for any life insurance policy.
Okay, so term,
whole life, or universal life, it doesn't matter. It has very preferential tax treatment. Okay. Death benefit does.
So that, I think, is a pretty high level general description of a buy-sell agreement. Can we talk about maybe, so you're not dying, but you do need to make a transition in your business? Because I kind of feel like that's sort of a critical thing. Are you game to head down that track for a little bit?
Sure, you bet.
So you want to sell your business. What do you do? Where do you start?
Yesterday. So there are a few people out there that I know, and you would call them entrepreneurs, right? These are people who are going into business to exit the business. They have a purpose, they have a plan, and they have a timeline. But most people don't. Okay, most people go into business because they love mowing lawns and they can build a lawn mowing business, or they love building buildings, so they go and get a hammer and they start a business, or whatever it is, right? Because that's a love of theirs, so they think they can make money at it. And they don't necessarily think about the end in mind, right? So I think what happens most often, and I think you're probably going to ask me this question is my guess, I have people come to me and say, hey, I want to sell my business, and they want it sold like yesterday or today. And I'm like, that's not happening. We have a lot of stuff to do before we can do that. And it all depends on what their goals are. But a lot of times they've already mentally quit that day, and we have to re-engage them. And that's where a business coach is so critical, to be able to help them put on the boots again and get back in the field and do the work and get that business where it needs to be so that they can realize what they built.
Yeah. So just to kind of double down on what you've just said, that some business owners go into business knowing that they have like an end time that they're building something to sell it at. Again, not often the case. So if you think that you are interested in selling your business, I would say the time frame is no less than 3 years, up to 5 years, to be able to get it to a point where you actually get the most investment out of it by growing it to a point
Hmm.
and managing it in a way that you can actually get some true value out of it.
I agree.
Yeah, yeah, that's great. Um, so who, other than an awesome business coach or executive coach to help you build your business, who else do you enlist professionally to help you in a transition?
Yeah, that's a long list.
Yeah.
Yeah. So the first person that I would probably call there's a little niche business. They're business transition consultants. It's like a business coach, but they specifically focus on this little sliver, and they partner really well with people like yourself. In that, what they do is they help get the books proper. They help set the business up and make sure that you have something to sell. Because if you actually are just if you're just employing yourself, that's not a real business. That's a job. You've actually got a glorified job. So these folks actually help you set up so that your business is worth more, and then you actually can transition to a competitor, to internal, doesn't matter, to whoever you want to transition to, and that you're in the best place. Your CPA is really important, making sure that they're on board so that they understand that. I'll talk about this in a little bit, how the CPA can come into the equation. M&A attorney, again, somebody who actually has done the process of selling businesses, not just your business attorney necessarily, although it might be the same person, we don't know. Your business coach is really critical. A commercial insurance advisor is really important, because if something catastrophic happens in the business, there's not going to be enough time to recover. And we need to have the insurance coverage proper. So we need to make sure we're in a great place there. Make sure that we're working with your financial advisor so that you can actually realize what you built and actually transition that. Because the biggest complaint, the biggest challenge I see with business owners, I've seen it in the last year here in the Valley, is a business owner that wanted to transition but realized that his business won't create enough, the cash from the business won't create enough cash flow to be able to have him realize the lifestyle he's hoping for.
Right.
And that's really disappointing. But guess what? I'd rather know up front that that's the case so that we can actually get there, hopefully, and build it to the point where we can actually take advantage of that sale. And then the last would be the traditional business broker, somebody that I would have conversations with. Whether you work with one or not, I don't know. That's up to you. But that's the 7 people that I would probably put on my team. There's probably more, but those are the 7 people that come to mind.
Can you speak to the experience of whether it's common that when we talk about business transition, is it often done in a way that is more of a fire sale, or is it I don't know, I don't have enough maybe exiting businesses. I'm growing businesses at this point in my career with the clients that I work with, and we've transitioned a few, but successfully, to partners and or leadership that exists.
Mm-hmm.
So are most businesses sold through a broker?
A lot are, but now keep in mind that when you go up on the market like that, typically it's 20 to 30% that actually sell.
Only 20. 30.
Yeah. So your best option is an internal transition, or a handshake agreement with your buddy across the street who owns the mechanic shop across the street to take over for you. That sort of thing. Yeah, only 20 to 30% actually sell through a broker.
As like selling your home, only 20, 30% of homes businesses sell. Okay, interesting.
Yeah. Mm-hmm.
I realized that was so low.
Yeah, it is. And it's because there's not a real marketplace per se. So the brokers have to go out and try to corral a buyership. It's unlike the MLS where you have all eyeballs on it.
Right.
It's a very fragmented marketplace. You can't I guess you probably could put your business on eBay, but I don't know that would work.
Well, I guess that's kind of, I almost want to say it's like a rude awakening for anyone who's listening to this, that you don't bank on a broker selling your business.
Yeah.
It's rare.
Yeah, it is rare, but with the right ones who have specialties. So if you're in the business of being a mortician, for example, you're probably going to want to go to somebody who actually has other morticians as clients, and they will probably be able to pair you up right properly if that works. So, but you're correct.
Well, David, I've kind of gone through my list of questions. Is there anything I didn't think to ask you?
Yes. So yeah, there's actually a couple of things that I had in mind in regards to these things. The buy-sell agreements, keep in mind it's just a contract. Make it as simple as possible. You just want to buy out your partners and hope that it never happens. Hope we never have to come to fruition. The other piece of the transition that there's two other steps to this that are really important, and keep in mind that patience is probably the biggest virtue that you can have as a business owner trying to transition. I mentioned starting yesterday. Well, I mean, because that's the nearest point that you can start is yesterday, right? The 2 to 3 to 5 year time horizon is realistic to get to get your company structured properly. And I mentioned CPAs. CPAs are notoriously awesome at doing one thing, and that is reducing your taxes. Okay, they're fantastic at that. But what does a business buyer buy? They want to buy income, right? Whether it's however it is, it's income. So if they're running all kinds of things for the business that aren't necessarily business related, and it's reducing the taxable income, that's not going to work very well when they go to sell. So they're diametrically opposed. The valuation of your business is based on the income stream that you create out of it. And if you're reducing that down for the IRS, it's going to reduce the value of your business. So work with your CPA and business transition consultant to get that right shipped. Okay. Finally, be discreet. Okay. One of the biggest things that happens is a business owner gets so excited, I'm going to sell. Oh, great. Now everybody knows. And it goes on Facebook, and their friends call their friends at the other businesses across the street, say, Johnny's going to sell. Johnny's going to sell. What does that do? It potentially gives your competitor an advantage, right? Because they're looking at your business like, well, if John sells something to me, is he going to be in business to service me after the sale? The answer is, I don't know. So why would I do business with those guys? So your revenue could be impacted by doing something like that. So be discreet. And it also has a meaningful impact potentially on, it can have a bump, but likely not. If the employees don't like you, it's going to be a bump, but hopefully that's not the case. So, but if you're running the business right, and you tell everybody, hey, I'm selling, well, morale is going to be reduced because they're all thinking, oh my God, what are we going to do? Are we going to be here? Are we going to have to go somewhere else? Is he going to stay in business long enough for me to collect my bonus? How's this going to work? So be discreet. So start yesterday, enlist help from all your professional friends, be discreet and be patient. Those are the 4 things that I think are really critical for selling your business.
Yeah. I particularly like the shift in mindset that has to happen when you are deciding to sell your business to actually have it be valuable. So gems of information. David, thank you so much for giving us some insights into how we can do buy-sell agreements as well as business transitions. It's been very helpful.
My pleasure.
I do want to leave with what is the best way for people to connect with you should they seek your guidance?
They can call me. Well, my phone number is area code 206-856-5325. I'm happy to answer calls. Or they can email me at david@gemstate, GEM, statefg.com.
Fantastic. David, thank you so much.
My pleasure.